All right. Hi, everyone. This is James Zhang, and thanks for joining. So what we're going to go through today is really just talk about what financing options are out there. I'm going to go through some case studies and then talk about forming your sponsorship group and then also the current financing market. So let's just jump in on these slides. So my background, born and raised in Houston, went to school in Austin. I've been an underwriter for 8 years at G Capital. Then I switched over to be a mortgage broker and really focused in on multifamily for the last 5 years, doing about 800 million across 125 properties nationwide. And I've also invested as a limited partner in probably 26, 27 properties. We sold 6 or 7, so about 20, 21 properties across 6,000 units in DFW, Austin, and San Antonio. So pretty familiar with the space. And so, I like to put this out. This is like really 3 types of investors, right? So there's the individual, the general partner, and the limited partner. And the individual, they do everything, right? So they find the deal, they sign on the deal, they put up all their own money. And there's a lot of people who are individual investors right now that are trying to buy like a $3 to $4 million deal. Their wife or husband might be a doctor and they're the real estate professional. And so they're taking advantage of a lot of this bonus depreciation. If you go to the middle column, the general partner, that person does everything, but they don't put up all the money, right? So they find the deal, sign on the deal, negotiate the deal. But in return for them finding the deal and doing all that and doing all the legwork, they receive an acquisition fee and or sponsorship equity. And so their job is really finding new deals and limited partners. And then if you're a limited partner, you don't do anything really except find other general partners to invest in. So that is what the job of the limited partner. So I'm going to be using these sort of 3 or 4 types of investors in going forward. So I wanted to just sort of lay the groundwork of what those people do. So here's a chart that I like to show that really talks about the 4 types of loan options. So you really start on the left side with bank loans, move your way to Fannie and Freddie, and then non-recourse bridge is really on the far end as you become more and more experienced. And so this is pretty daunting for a lot of people to go through. When you're first getting started, most people start with the bank loan. It works for new investors. It's shorter term, and pretty much it works for any property occupancy. It works for any property loan amount. So that's sort of the standard bank loan. Unfortunately, it has some downsides, right? So it's recourse. It's 20 to 25 year amortization. It's only 3 to 5 years. And, it's, after it has a lot of issues in terms of, it puts your personal balance sheet at risk. So that's probably the biggest thing. So as soon as people can move into Freddie Mac and Fannie Mae, they do. And they find properties that are stabilized, but maybe with a value add component. So it's 90% occupied for 90 days. That is a big qualifier here on this chart. And they really want loans that are above $1 million. And you can go out now with Fannie and Freddie, you can go out and set loans for 5, 7, 10, 12 years. And then, once you are stabilized or once you, get past Freddie and Fannie, some people move into non-recourse bridge, but a ton of investors stay in the Freddie and Fannie bucket. So when I talked about deals that I've done over the last 5 years, 80% of the loans have really been Freddie and Fannie because those are the dominant players in the market. So when we talk about, where you're getting loans right now, it keeps coming back to those guys. So this sort of lays out a framework for you guys. So I wanted to have a little fun, and I've done this a couple times. I like to think of these loans as different ice creams, right? So in Texas, it's pretty hot right now. And, the Fannie and Freddie, I like to think of that as sort of like your vanilla or vanilla with sprinkles. If you go over to the non-recourse bridge, that's sort of like your coffee ice cream. This is, I put it coffee because, there's a floating rate term. It's a 3-year term. It's typically higher leverage. So it's for the higher energy people, the people who want to get in there, turn the deal, sell it, refi it in 18 to 24 months. And then the recourse bridge, sort of like your bank loan. It's not stabilized. I call this the rocky road. It has nuts. it's some people are allergic to nuts, some people are allergic to recourse. So that's what I used for recourse bridge. So I'm gonna go through some examples, some case studies here with you guys to give you an idea of when people have used these types of loans. So this was a deal, 60 units over in Fort Worth. It was bought for about 3.6. Rehab was 700,000. It was 95% occupied, but the owner just had not been pushing rents. So the rents were 20% below market. So they came to us, and O Capital is a mortgage broker. So we really looked at all different types of loans to figure out sort of what the best execution was for the borrower. So if you start sort of Fannie Mae, vanilla ice cream, they were at 70%. Because Fannie Mae, they're going to look at the debt service, and the debt service is, your NOI divided by your debt service has to be 125. And so they were sort of stuck at 2.9 million on this deal, which is about 70%. Freddie SBL, they also have the 125 cover, but they were able to get to about 2.8 million. Non-recourse bridge, they could go up to 3.5 million. But it was a higher rate. So their rate was close to 6%. And then recourse, they could go 75% loan to value, 3.3 million, but the rate was higher, shorter term, and is recourse. And so on this particular deal, it sort of goes against, so the lowest loan amount won on this deal. So Freddie SBL won on this one. The borrower chose it because it got essentially the same rate as Fannie. It was a little bit higher, but it got a step down prepay. So step down prepay means it usually starts at a 5% and it goes down to 1% of the loan amount as your prepayment instead of yield maintenance. So yield maintenance is a lot more expensive because essentially you're essentially paying all your interest payments right then when you prepay the loan for the remaining loan term brought back to present value. So yield maintenance is so on this one, instead of let's say a 3% prepay, on the Freddie SBL, it probably would have been like 10 to 15% of the loan amount, which would have been a lot higher for the exit. So while the interest was a little bit higher, the interest rate was a little bit higher on Freddie SBL, it worked out better for the buyer to go with Freddie SBL on this deal. The second deal, all right, so this deal is Shadowwood, 60 units in Garland. And on this deal, we did the loan for the owner. They came in, bought the deal with a recourse bank loan probably about 2 years ago. And their all-in cost basis was $3.4 million. And then they said, hey, James, we raised rents, we improved the property, put some money in the deal, and now we think it's worth $4.5 million. And so we went out, did an appraisal, and it was appraised for $4.5 million based on the cash flow, based on, the income approach. And what they did was, all right, now you have options, right? So essentially you can typically go up to 75% on refis. And so we looked at Fannie, we looked at Freddie, we looked at non-recourse bridge, and then we also looked at recourse as well. So they were all essentially the same loan amount, but Freddie SBL came with that step down prepay. And on this particular deal, they were able to do a full cash out of so they took the deal, 4.5 million, paid off the old loan. I think the old loan was around like $2 million or so. And they kept that, that difference between the 3.4 and the 2 million. And now they essentially have no cash in the deal. So that's a way to refi a deal. So when you're thinking about forming your sponsorship group, so these two deals were essentially smaller syndications. And so they just had 2 or 3 people sign on the loan, and it wasn't a huge deal. So it was similar to this. If I handed you a 100-unit deal and gave you a $4 million loan, you need $4 million net worth to qualify for the loan. You need $400,000 post-close liquidity, and then you need prior multifamily experience on Fannie and Freddie. So a lot of people will ask, well, as a sponsor, how do I get paid on doing the deal? And so a lot of times the sponsor will get 20% of the equity, let's say. And so I did a common breakout down here in the bottom left on, all right, let's say the first investor, they found the deal, they're raising equity, they might get 9% of the 20. The second one has multifamily experience. They might get 8%. And then the person who's maybe just raising equity, 2%. And then the person who's signing with net worth and liquidity, they get 1%. So most valuable things are finding the deal, multifamily experience, and then I would say raising equity, depending on how hard it is at the time. And then net worth and liquidity is probably the lowest. So as you think about sort of building your resume for future deals, think about those 4 different things. And so a lot of people ask me like, all right, so what is a key principle? And this is a sort of Fannie Mae, Freddie Mac term, and it sort of sits in between general partner and limited partner. So a key principle is essentially somebody who signs on the loan, but they might not be doing the day-to-day activity. And so, hold on one second. They might not be doing the day-to-day management of the deal, asset management of the deal. And they're not really going to control, the sell refi. They're not necessarily going to find the deal, but they might receive some equity for signing on the deal because they need that person's net worth and liquidity or experience to qualify for the loan. And so some of these, I want to go through some larger deals where essentially people came together. They added key principles to the deal so that they could qualify, right? So this is a 105 unit deal in Fort Worth, and it's 9.5 million. And we looked at the 3 different options. Freddie SPL only goes up to 7.5 million. So that one was sort of capped out on this particular deal. So we looked at non-recourse bridge, we looked at recourse, and then we looked at Fannie Mae. And on this one, they wanted a longer term. So instead of recourse, instead of non-recourse bridge, which is typically 3 to 5 years, they went with Fannie Mae. So they were able to get about 3.75 for 12 years with 3 years IO on this particular deal. Azul, so this one was 32 million, 2.6 million in rehab. And we took it to Fannie Mae, we looked at Freddie and recourse. And, everybody sort of capped out at 26 million or so. And then non-recourse bridge said, all right, we'll do purchase price plus rehab at 80%. And so that was $28 million. So about 2 million more in loan proceeds than the other. So they had to raise about 10 million on this deal. About 8 million on this deal to do the deal. If they had gotten Fannie, it would have probably been, they had to raise 10 million. And so they chose the non-recourse bridge. So they're doing the rehab right now. And then their goal is to refi or sell the deal in probably 2 to 3 years from now. All right, so that gives you an idea of sort of the different loan types out there. If you want to put any questions in the chat about those, we'll hit those in the Q&A. But here's just a snapshot of sort of what's going on in the market right now in terms of pricing on deals and interest rates. So on the left-hand side is Fannie Mae. So most of the deals are in that 3 to 325 in terms of rate right now. If you go to the right-hand side, this is on the Freddie Mac side. Freddie Mac small balance, you're probably closer to 3.5 to 4 on Freddie Mac small balance. And then if you do elect for step down prepayment, it'll be higher end of the range, whereas yield maintenance is on the lower end of the range. And then if you look at sort of life companies and CMBS, they're really only quoting apartments in industrial, retail, and hospitality are essentially shut off right now. So multifamily is a great place to be. I wanted to share some stats from Fannie and Freddie. So Fannie, every week they put this out. They say, all right, how many loans are in forbearance? And forbearance is essentially owners who have raised their hand saying, I can't pay the debt service right now. And so in April, it was pretty small. May definitely jumped up. And, June and July, it sort of has stabilized a little bit here. So there's about 4.5 billion in forbearance right now on the Fannie side, about 286 loans. And they just extended forbearance relief because of COVID. So you get additional 3 months, but you have to pay that 6 months of forbearance back within 24 months. So they're not tacking this on. So you haven't paid forbearance for, let's say 6 months, and let's say it's 100,000 a month. That 600,000 is due within 24 months. So they're going to spread that out over 24 months, and they are not just tacking it in on the end of your balloon payment. And during this time, they are essentially sweeping all the cash from you, and you cannot evict tenants, you cannot get late fees, and you have to be flexible with the tenants on prepayment or on repayment of rent, because Fannie Mae is being flexible with you. So they are allowing you to not pay your loan right now. So you have to be flexible and you have to set up basically payment plans with your tenants. Freddie Mac, they put out only forbearance stats once a month, but they are a little bit more in detail. And Freddie, they had over 1,200 loans, or close to 1,200 loans on their last report, and 75% of their loans that are in forbearance are small balance loans. So they have a small balance loan of $1 million to $7.5 million, and they have a conventional business, but 75% of them, of the loans, are small balance. And they said, they had, most of the Freddie SBL are B and C properties, and they're just smaller, right? So if two units move out, all of a sudden you go from 100% to 90%, and then if 6 people move out, then it's 70%. You can't make your debt payment. So and a lot of these smaller properties, they have tenants. Typically we're in sort of non-essential businesses, and they have been shut down, like your restaurants and hotels and things like that, and retail. And then they also sliced the data another way and said, look, about 10% of the loans are student housing and 10% are senior housing. And so I guess that just gives you a little bit more information about what the lenders are seeing out there in terms of what is hurting and what's coming down the pike. So they're giving the same forbearance options. They got 30 days, and now they're going to give another 30. Or sorry, they got 3 months, and now they're getting another 3 months. But they have the same restrictions as Fannie in terms of you can't evict tenants and no late fees and things like that. And so in March, Fannie and Freddie really decided, all right, this COVID thing's hitting. We don't know what collections are going to be. And so they put out all these guidelines around reserves. And, on this chart, I sort of had all the guidelines from the beginning. So Fannie said, all right, we're going to do 12 months principal and interest. We're going to do 12 months of taxes, 12 months of insurance, 12 months of replacement reserves. And that was about 10% of the loan amount in reserves. So what that meant was, let's say you're doing $10 million loan, you had to put $1 million up with Fannie Mae. And not until essentially 12 months later would they release the money if you had a 125 debt service coverage. So they were going to hold that money and use it for, if you couldn't pay the debt service. Probably back a month ago or so, they said, all right, we're going to take off the taxes, insurance, and replacement reserves. And now we're just going to keep the principal and interest. So that dropped it to about 5% of the loan amount. And then they also said, all right, instead of 12 months, we're going to hold it for 9 months. And so that was the last change. If you go lower leverage, it decreases your reserves. And if you do a loan assumption, then you do not have to put up these reserves. So that is the latest from Fannie. In terms of Freddie, similar, they want 12 months P&I on the Freddie SBL, and then Freddie conventional, they want 9 months P&I on debt service under 140, and then 6 months P&I above 140. And they want all federal shelter in place released, and you need to hit essentially 3 months collections greater than what you were collecting at close, and then you can get the money back. So typically that one's going to be about 12 months that they're going to hold it as well. So now I wanted to open up to Q&A. So if you guys have any questions, if you want to put it in the chat, we can go through and answer those questions. And then while you guys are doing that, we can, there's some questions that came in before the call. So I'll just go ahead and answer some of those, and then we'll get into the chat questions. So Eric asked, what are challenges you're seeing in a post-COVID environment? So Eric, on this one, I would say, the biggest challenge that owners have right now is if they needed to, let's say, evict somebody in March, and the courts closed all of a sudden, they could not get that person out. And they have not opened the courts back up for a lot of places. So that person has been sitting there for 4 months, and they have not paid. So I would say on the owner side, that is probably the biggest challenge. But from the lending side, I would say the biggest thing that is bothering people is reserves. So putting up those reserves and raising that amount of equity is probably what I'm seeing. There has not been a lot of deals that have come out recently. I would say there's only, back in January, February, there was, let's say in DFW, there was probably 20, 25 deals on the market. And right now there's probably 5 to 10. And in March, April, there was probably 1 or 2 off-market deals. So let's see. So Joel asked, how do you find limited partners to invest in your deal? I would say there's a lot of different ways. I mean, some people will go to friends and family. A lot of people will join investment groups where there's just already a built-in network to invest with you. That's probably where most of the people start. And then, in this age of, YouTube and podcasts, some people will start those platforms and build their lists that way. So that's what I would say on finding limited partners. How to find deals to invest in. I mean, a lot of people will sort of start on LoopNet and things like that. But what I found is in Texas, a lot of times the listing brokers control the deals, and the listing brokers only send it out to their list. So they don't post their deals on LoopNet and things like that. They send it out to their email list. So you have to get on the email list of the listing brokers. So I'd probably find the top 10 listing brokers in your market that you want to buy deals in, and then get on their email list, start underwriting their deals, and then build credibility with those listing brokers so that they show you the deals early on in the process. This question was around financing new construction. So there's really 2 ways to finance new construction. One is just doing a recourse bank loan. They usually have a shorter time frame on it. It's usually 3 to 5 years on new construction. But then another way is there's a HUD product called 221D4, where it is probably a 9-month process to get new construction done. So we just did one in Austin that was for $40 million on 300 plus units just outside of Austin. And there's a lot of hoops on that one. And it takes longer, but it's typically a 30 or 40 year product, and it's non-recourse and it's higher leverage. So depending on the size of the deal, then that's going to determine how to finance new construction. Carrie asked, do you anticipate bridge loan rates to come down? So right now, bridge loans, they're priced over LIBOR. So LIBOR right now is like 20 basis points. So it's nothing. But the all-in rate on bridge product right now is probably 5% at least. The problem isn't really the rates right now. The problem is there's not that many bridge loans lenders out there right now. So most people don't want to go out and put a 2 to 3 year loan on a property right now, because they might just end up owning the product 2 years from now if rents don't grow and you do your rehab and you can't push rents, and you're going to be stuck with the property. So bridge loans typically are for value add properties where you come in, do the rehab and then raise the rents $100 a unit. But right now it's going to be difficult to raise rents. In terms of Van asks, what's the best way for a low net worth GP to secure financing? And it sort of goes back to how we were talking about your sponsorship group. And if you have general partners and they want, you might find the deal, you have to bring something, right? So if you have the deal, if you have the ability to raise capital, if you have the multifamily experience, then your net worth and liquidity can be offset by bringing in someone with strong net worth and liquidity. So you have to think about that as sort of pieces of the puzzle, and think about what you're bringing to it. James asked, how do you get your first deal? So I'm not sure if this is coming from a general partner side or limited partner side. I would definitely say on the limited partnership side, you just have to get out there and find GPs to work with. And that might be your first step to getting your first deal as a general partner, right? Because if you invest with someone as a limited partner and they get to know you, then you can potentially partner with that person on your first deal to get your experience box checked from there. So that's probably the easiest way. If you want to go out there and find your first deal, definitely go back to what I was talking about with listing brokers and start figuring out who the listing brokers are in that market that you want to be in. Next question is, how are groups underwriting vacancy, cap rates, rent growth today versus pre-COVID? I would say everybody's, especially the first year one, year two, economic vacancy is higher, right? So if you were, people were probably underwriting, let's say 10% economic vacancy, which is, vacancies consist of physical, which is, nobody's in the unit. And then, economic includes physical plus bad debt. So people who are not paying you, concessions, people, deals that you gave to people when they moved in. So those types of things. And so I would say it probably moved from 10% to probably closer to 15% right now in terms of vacancy. Cap rates, I would say, it's probably, most people added about 50 basis points, so 10 basis points a year. It's probably 75 to 100 basis points now on cap rates. Rent growth today, I would say 0 is what most people are underwriting on the first year, and then, probably going with inflation after that. Zach asks, what refinancing options are available? So I showed a couple refis. Most people are doing Freddie SBL loans on refis. They take a little bit longer. But they can provide cash out, and a lot of people are going from recourse to non-recourse that way. So Aid asks, how does a first timer attain the loan? I'd say if you're a first timer and you're just an independent owner and you're fine doing recourse bank loan, that's the easiest way, right? But if you want to buy something that's a little bit bigger, you need to sort of form your sponsorship group and then start assembling the pieces of the puzzle, right? So somebody with experience, somebody with net worth and liquidity, and then go out there and start trying to find your deal. Jerome asked, what loans are getting approved? I'm staying right in that middle lane. The Fannie and Freddie stuff is what I feel confident in right now. They're not going anywhere, whereas the recourse bank loans and the non-recourse bridge, those are having a lot more issues. We had a deal, it was close to $12-13 million. And our buyer didn't win the deal, went to another buyer, and we didn't hear about the deal for 2 or 3 months. And then we get a call from the listing broker saying, the buyer that we weren't working with, but that buyer, had a bridge loan lined up all the way until the very end. And then the bridge loan lender pulled out. So I would stick with Fannie and Freddie. Those are the deals that are getting closed. We're getting approved, and those people are closing on time. Fong asks, can you do cash out refis on less than 60 units? Yes. Really, the loan amount is more important than the number of units. So I would say $1 million loan amount and higher is what we look at, and LTV 75% is what you would have on refis. Roger asks, how do you structure sponsor comp? I would go back to that chart around the puzzle, right? So if you're bringing the deal, if you're bringing the multifamily experience, you're going to get most of the sponsor comp. So let's say 20% of the deal, those guys will probably get majority of it, 75, 80% of that. And then the people who are bringing net worth and liquidity are probably going to get a little less than, I would say 1 to 2%. So Joel asks, is there a publicly available list of properties that are in forbearance? There is not. You have to pay for that. And so they have not released that publicly anywhere. They sort of give, you have to do a little research. They give some items about the loan, but they don't give like the property name or anything like that publicly available. James asks, when you refi, do you have prepayment penalties? Yes. So when you refinance a deal, if let's say you have a Fannie loan or Freddie loan on there right now, it's the same as if you sold the deal. Like they have a prepayment penalty on that. Mahmoud asks, how do lenders distinguish between apartments and student housing? So it's the percentage of students that are in that property. One or two students is fine, but once it gets probably over 25%, that's when they really start looking at that and considering that student housing. Joel asks, do all of the loan types you reviewed potentially include money for renovation in the loan amount? And so this is where most people get confused is when Fannie and Freddie underwrite a deal. Let's say it's a $9 million purchase price, $1 million loan. So $10 million all-in cost, right? If I can give you a $8 million loan and the property currently qualifies for $8 million based on its debt service, okay, then that allows you to that allows you to roll the rehab, okay? But let's say you buy the deal for $10 million and you want to put $1 million in rehab, that same deal. So now that's an 11 million cost basis and the property can't cover that debt service, then you can't roll that rehab. And so that's why it's a little bit different. It's based on the in-place debts or in-place cash flow that the property has right now. All right. So James asks, what's a good starting deal size for a first-time buyer? Depending on if you're buying the deal on your own or you're doing syndication, I would say if you're buying a deal on your own, if you have the money, I'd buy 50 to 100 units. If you're syndicating a deal, I'd probably make that a higher number. Probably 75 to 150 units is probably what I would focus on. Just because as a syndicator, you're raising money, you're doing a lot of other things that an independent owner doesn't have to do, and so it takes the deal needs to be big enough for it to be worth you doing. So that's what I would say on that. And then Mahmoud asks, how do lenders look at lending on totally vacant apartments that require full rehab? So that one is really, it's not going to, Fannie and Freddie aren't going to do that deal. It's going to be a bridge loan. And so that's going to be, probably a 3 to 5 year term. And it's going to be more based off of your balance sheet, your personal balance sheet, and go from there. Joel asks, how long do HUD loans take? So HUD loans work well for refinances. So if you have let's say a construction loan, and you want to refi, you could do a HUD loan. Or if you have a property that you're going to own long-term, then you can do the HUD loan. That might be 9 to 12 months. But the problem with the HUD loan is that most people don't own these properties for 10 years or 20 years. Most of the time, people are owning these deals for 3 or 5 years. And if you're buying a deal, the seller doesn't want you to take 9 months or 12 months to close on the deal. They want it closed in 60 days. And so most people who are acquiring deals are not doing HUD loans, but on refinances, people are doing HUD loans if it makes sense. And, when people should reach out to me, his next question, it would be when, let's say you get a deal from a broker or you underwrite it, makes sense, it works at the whisper price, and then send me sort of T12 rent roll and OM, and we can sort of take it from there, get you a term sheet, and help you on the debt from there. So appreciate everyone jumping on. If you need any help, reach out to me. We help you with the term sheet, deal review. Subscribe to my YouTube channel if you haven't gone on the YouTube channel. That has a ton of information. And then, really the first thing that I ask people to do is really set up time with me to sort of go through their PFS, and we can discuss sort of buying, selling, or refinancing your next deal. So I'm going to sort of pause it here and